Okay, good afternoon. It is afternoon in the Eastern States. Still morning over here in WA, but either way, wherever you are, welcome to the weekly market analysis session. My name is Carl Capolingo. I'm the market analyst over here at Think Markets Australia. It is a pleasure to be with you as we wrap all of the major events from last week and look to the week ahead. Kicking off with cryptos first. Not a great week for cryptos. And just a reminder, I take this snapshot on a Saturday to Saturday basis. Obviously, crypto trades 24/7. It may have changed a little bit since then. If anything, we've seen a tiny recovery, but not going to change too much the fact that it wasn't a great week for crypto. In particular, Cardano down about 12.6%, but maybe just Bitcoin and Ethereum seeing modest falls, ebbing away from there, getting worse and worse, of course. Having a look at the fear and greed index, we're at 20. That is definitely in the extreme fear region and down from yesterday's reading and down from last week as well. No major narratives out there in crypto land, unfortunately. I wish there was something driving crypto higher. It's just gone quiet, and that is the nature of crypto winter. It's not unusual what is happening now. This is normal. This is how crypto functions, and you can see the result in prices. And that's what I'm really more interested in is, well, all the news, all the narratives, all the FOMO, all the fear of making money and losing money out there boils down to demand and supply, and that is what the chart is. It's just pure analysis. And it's going sideways, isn't it? So there's not a whole lot to do. A pulse for Bitcoin would be a close above 24.50. More than a pulse, a little bit of a kick, 25.366, close above that. And actually, I reckon there's some FOMO in the market. And we could see, dare I say, the start of the next bull market. More than likely, though, we're going to continue to trend in this long-term trend, which is down. It's clear, the dark pink zone, the short-term trend is down as well, light pink zone. And 17,585 would be that key level to the downside I'd be extremely concerned about. Let me go to here, and oh, boom, there I am, popped up. So at least we can see each other. The Ethereum chart, not much better, still long-term downtrend. Let me give you the pulse, 1422. We've got a pulse above that. Bull market not until 2031. So when you put that into perspective, if we're around about 1200 at the moment, for the better part of doubling here for Ethereum before we can call it a bull market again. To the downside, look, there should be plenty of demand around that 1,000 handle and into 880. I would want to see it get beneath that. Scanning through the top 100 cryptos this morning, there is one standout. It's been a standout for a few weeks, actually. I tipped this on Cracking Crypto late last month, so a few weeks ago now, as my top pick in the top 100 cryptos, and it has done very well. I reckon that was around about 140 to 150. So we're at 190. That's a good gain. 200, possibly a little bit of psychological supply coming in there, but 237, that December 2021 high, I think, is the ultimate target for this. There are going to be pullbacks along the way to the light green zone. That's a short-term uptrend, but otherwise, it's looking good. I mean, there's a short-term uptrend, long-term trend has changed. We've broken above that zone. What was turned from dark pink to orange, that's your transition phase. You move above it, you come back, you test it, you hold it, you go higher, and eventually that'll turn to dark green, we hope. So happy to stick with that if you're on it from any of my previous recommendations. Going to add a new one to the list today, Ethereum name service. I mentioned it on Friday on my spot on Ausbiz, and it looks pretty similar. If I go back to Quant, you can see some of these hallmarks of trend change, this long-term trend transition. We need to have a short-term uptrend. Okay, we've got that. We need to interact with that long-term trend zone. It needs to go from a dark pink to orange. We're doing that. And well, the only thing I think we're lacking here is the test and hold. So pulling back to that zone potentially and then moving higher off it would tell us that we're now in that longer-term uptrend or making that transition. It may not pull back. I think the last three candles actually pretty solid after, it's going to be, if that's Sunday, Saturday, is probably Thursday's up candle there. It's definitely a control, demand side control pattern. So happy to be a buyer of that 127.64 is probably your intermediate target. Dare we dream about 50.74? I think we probably need something kicking elsewhere in crypto world for that to occur. Okay, bringing it back to stocks now, and I might just hide away for a second so you can see the European markets. They're not much to see. FTSE down about 2%, and the continental markets there up slightly. Look, the big news really, the NASDAQ composite down 3% for the week in what was a massively volatile week, both up and down. So net, I guess you can see the volatility index not really doing a whole lot. But it was a very volatile week. S&P 500 down 1.6%, yet the Dow rising 1%. Asian markets, I think, seeing there clearly an outperformer to the downside, down 6.5%. Okay, heading to the next chart. Here on the S&P 500, giving you some trends and key levels. Trends, definitely short-term downtrend, long-term downtrend. So we're still in the bear market. That thesis hasn't changed. What has changed is this giant white candle that popped in on Thursday. Now, that was on the back of worse than expected CPI data. Market gapping down on the open there, and then rallying, almighty rally, closing near those highs and staving off, a break of that 35.88 key demand level. And I think, fair to say, surprised many investors. Perhaps less surprising was the response on Friday, which is just moving back in trend. But I was going to use the language disappointing. They're disappointing. We've got to get this volatility. There's these rallies and hope given to investors when really we should just get on with the job of going down within this bear market and finishing this move to the downside. But hey, some of you are probably shouting at your computer screens right now saying, hey, Carl, how dare you? My portfolio is at stake here. And I say, well, it's not because I told you to hang on to it. In fact, I've been telling you that I said in January, it's on file, it's on video. January 21, I said the bull market in US equities is over. Okay. And on that day, in fact, I predicted crypto winter coming. Well, kudos to me, big deal. Where do we go from here? Well, I'm a bull, and I was the biggest bull. I was the biggest bull through here. And now I'm a bear, alas. I'm a bull in a bull market and a bear market. Decide what you want to be. Be a bull, I guess. Take a stand. Say, hey, no, Carl, you're wrong. The economy's going to turn around. Things will turn up, and this is the bottom for stocks. And that's what Thursday's move was all about. That's fine with me. Maybe you're right. Be a bear like me and say, hey, the trend is down. The path of least resistance is down. Supply is in control, and I'm not going to fight this. Be a bear. That's wonderful. Just don't be an ostrich. I think that's the worst animal you could be in the markets, is where you stick your head in the sand and just go, you know what? I've got no idea what's going on, and I'm just going to hold on and hope for the best. Eventually, the market will go back up. Look, it will go back up. Make no mistake. This 48.19, we're going to be higher than that somewhere down the track. I don't know how long it'll take, but we'll be higher. We'll print a 5, we'll print a 6, we'll print a 7, we'll print an 8. That's the nature of capitalism. But how much damage can be done until that occurs? How long will we have to wait? So I think I digress a little, but NASDAQ composite here, similar, taking out that key level at 10,565. The next level is 98.38, by the way. And then, rallying Friday, perhaps the dose of reality. I did rate in a tweet, you follow me on Twitter if you like, the handle is @CarlCapilingua, but I did put out a tweet on Friday giving you probabilities, based upon my experience, which is this is, the third major boom crash cycle I've gone through. And I said, based upon Thursday's candle, I can get up to now a 5% chance that is the start of the next bull market. I think I said 25% chance it starts, a substantial bear market rally. And a candle like that is indicative. It's consistent with a substantial rally on the way. I think I said, though, 50% chance is probably the biggest probability. It would hit the pink zone and then flame out, and down we go. 10% chance we go sideways. I just don't think it's a sideways kind of market. I just think it's an up market or a down market, given the volatility, the extreme volatility we're seeing. And then I said a 10% chance it will just flame out straight away. So I didn't give it much chance of doing what it did on Friday. But look, to be fair, the vast majority of probability I had being skewed continued to the downside. Having a look now at some of the commodities, and this is the key. So Thursday. Okay, Thursday had that huge risk-on rally. It was very much focused on equities and bonds, but what didn't participate was commodities. And commodities must participate, everybody. It's so important that commodities turn around and start to go up, to tell us that that global economic growth picture is improving, and it's that improvement which will eventually cause earnings to improve, and that's where the stock market's going to get its boost down the track. So until these turn up, I'm going to be very skeptical, as I was on Thursday, of that rally. Nickel, so look at the key ones here. Obviously, the key industrial metals, nickel down nearly 3%, not great. Copper was up a little bit, actually, in the US there and in London, to be fair, and that was mainly on that Thursday candle. And then iron ore was down, let's call it down 1.4% in Shanghai and about flat in Singapore. The precious metals were hit pretty hard, but they are not commodity based. This is growth based. This is a growth based commodity here, coking coal. So you use that with your iron ore to make steel, and steel production is a really good gauge of future economic growth. So an improvement there, somewhat encouraging, but the overall trend, I think, is still very much set to the downside, as it is on copper. Dr. Copper, that ubiquitous industrial metal, it's used in so many industries for so many purposes. This needs to turn up for me to get confidence in that global economic growth picture, and therefore that equities have a chance of pulling out of the bear market. Nickel looks very weak, and that's a ditto for copper. I guess it needs to turn up. I'm just not that interested in gold at the moment. I'm not a gold bug anyway. I would say the bias is clearly to the downside here, and no reason, I think, to get involved one way or the other, really, because of the last little rally probably turns it somewhat more neutral. But if you're on gold shorts, I would happily stick with those, I guess, if you're already in there, that is. Looking at the energy side of the equation, growing a little bit more neutral on crude oil. We can see from that rally week before last week, I should say, and a fairly mild pullback last week. I mean, it looks bad, but we're up about 14, it was actually 17%. I'm mistaken, it was 17% on crude oil last week, 17.3%. So to pull back 7 is not that bad, and consistent with my theory that we're moving to a more neutral stance on crude from our previous bearish stance. Natural gas down also. Aussie dollar commodities obviously struggling, so that was down substantially, actually 2.6%. And that's another key as well. So we're talking about, I guess, commodities rallying. Well, watch out for the Aussie dollar. That's got to go up as well, I think, as a precursor to the stocks ending their bear market, and bond yields continue to rise, and that was really important as well. We'll look at that in a sec. Natural gas, a lot of important charts today, or at least I'm calling them important. I think this is important. Watch this chart here, because as we'll see in a second, we talk about inflation data. It's still largely about what rising energy prices have done, now past tense have done, to the inflation picture, because we're actually seeing quite a substantial moderation. And if anything, this chart is telling me we could see 532 on US natural gas. Okay, we're already seeing the European, let me just pop myself back up there, the European gas prices come down. Now, of course, this can turn on a dime because you get an untimely blizzard, or a blizzard that's worse than the usual blizzard in either of those jurisdictions, and these will be heading up. But for now, excuse me, this is looking good for that inflation picture, and thermal coal prices edging down, even though Aussie thermal coal stocks continue to rise. That's interesting in itself. We have been trimming some of our exposure to those. Haven't done this one for a little while, but throwing it in because there's a little bit of a kick there, a little bit of a pulse at the end for uranium bugs. Spot uranium prices edging slightly higher and just getting close to that 50 US dollars a pound, but modestly, conservatively bullish on that one. I think that's warranted. And this is the US dollar index. This is something we do need to head back down again to move to a more risk-on stance, more sustainable risk-on stance. And that's actually a possibility with this pattern here. So, very strong motive phase to the downside, a lot of supply coming in, demand backing away. Yes, demand responded, but you can see that supply has responded by creating this lower peak here. There's a big candle there on Friday, so let's just see how that turns out. But, just watching out, maybe moving to a slightly more neutral stance from, wildly bullish there. I don't think we're moving to a neutral stance on this one. This is the opposite of the last chart. Obviously, US dollar strength means Aussie dollar weakness, but the Aussie dollar specifically is being, or the weakness there is exacerbated by those commodity prices, and that is just free fall. It literally is falling off the cliff. I don't have the weekly chart for you today, but if you zoom out, 55 cents is the likely target there. I did put some analysis on Twitter, so again, go check that handle, and I did put a video out on the Aussie dollar specifically if you're an FX bug. So go check out that one. Aussie bond yields still trending higher, although moderately so compared to their earlier run up in the year, but this is still very strong. US 10-year notes, and this is what's hurting the market, is these higher rates, but yet expectations of lower growth, your stagflation, your worst case scenario for your economists. And then we've got the 2-year yields, which on Thursday in that risk on rally they popped. And this is why I couldn't get excited about Thursday's rally, because commodities didn't follow through and 2-year yields continued to rise. And until we see substantial, at least flattening of these, it's hard to see a flattening in the bear market. And we'll need to see a reversal here to have any chance for the bear market to go away. And it's not even then, even if that does come down, it probably won't help, because it'll indicate we're in dire economic trouble. Talking about dire economic trouble, I've got this chart for you here, which is our yield curve comparison. Let me just hide there, because you can see the orange line is the current, the blue line is 1 week ago, and the dark green line there is 1 month ago. What we can see, and this has been happening if you're watching me on Monday mornings, we can see how this orange line continues to go up. And of course, it means we've got rising rates, which the stock market doesn't like. But then we've got this steepening inversion in the yield curve, where longer term rates, relatively speaking, haven't gone up as much. And that is because the market is betting that these interest rate increases are going to break the economy and break it in a bad way. And eventually central banks are going to have to slash rates, and that's why these long-term rates aren't going. But even then, at 4%, we're going to be stuck with potentially higher rates, which again is not good for stocks. Okay, let's have a look at some of the data now that I've depressed the hell out of you. What happened on Thursday? Actually, this isn't what happened on Thursday. This happened the day before. I'll do this one very quickly. It's just the wholesale inflation. It's the next one that mattered. But we are still seeing some nagging wholesale inflation there, up 3.3% month on month, which is 5.6% year on year. And that's about flat in August for the core, so that's not too bad. The headline there, plus 0.4%, which is 8.5% month on month. Month on month versus 8.5% year on year, I should say. And that was worse than expected. And we had a bit of a pullback last month. There was a 0.2% fall, so that wasn't a good reading, but it was a nudge lower than the August reading. We have seen second monthly slowing in the headline from 9.8% in July. The peak of 11.2% in March. We're still down from that, so that's encouraging. The core peak was 9.2%, so you can see there we're at 5.6%. So wholesale inflation, I think we can see here, it looks like we're over that hump. I think that's encouraging. Consumer prices generally follow wholesale prices within the next few months. The biggest inputs to the inflation here being food and energy. No surprise. And just note there, wholesale food prices up nearly 16% year on year. And that is, you think about if you're a Taco Bell, you know, one of those big US food retailers there, and you know, the input prices there and what that does to your business and your prices to customers. This was the big event on Thursday. So markets were expecting a 0.3% gain in US consumer inflation, and we got 0.6%. So that's why we gapped down. And then we look at the year-on-year gain here, which is 6.6%. And that was way up from August, 5.6%. And actually set a new peak in this run. So the previous peak was 6% in May. We've been hovering around about 5.9%. So to see that core rate jump so much, that's what disturbed markets. And then we saw, actually this should say CPI. That's a copy and paste error, sorry. So it should be CPI there and there. But I think we get the picture. Biggest gains in food, up 13%. For the year, but slowing from August. I think that's important. August level was highest since 1979. Energy up nearly 20%. Shocking. Electricity costs, which aren't part of energy, mind you, up 15.5%. I put milk in, so I think that's interesting, up 15%. Shelter costs up 6.6%, which doesn't sound like much, but when it's 2/3 of consumers' expenses, that is hurting. Talking about US consumers, consumer sentiment gauge was roughly flat. We saw it move from 59.5 to 59.8, which is, oh, well, it's going higher. Well, you know, it's still in the toilet, let's face it. But we saw current conditions jump. So how consumers are feeling right now, we've got a bit of improvement, maybe, I don't know, some of that up to, you know, Thursday's announcement and inflation moderating. But the expectations fell from 59.9 to 56.2. That got worse, and net there was a slight gain. The most disturbing part here, and that's why I've put it in bold, is year-ahead inflation rate rose from 4.7 to 5.1%. So it's all about consumer expectations of inflation. So yes, we're printing really hot. We printed really hot on the CPI, but the Fed's going to go, okay, CPI is volatile. It was up this month. It might be down next month. But what the Fed is looking at is, well, what are consumers expecting? Because because this is going to shape consumers' demands for higher wages, which could then lead to higher costs, which could lead then to higher wages, and you get this spiraling inflation. That's what the Fed wants to stamp out. So this is really concerning here, and I'm not sure if investors paid. Well, I was going to say I didn't hear about it a lot in the news, but then looking at Friday's response in equities, maybe investors did pay attention to that. Okay, I certainly did. And we saw the long-term inflation expectations. So this is up to 12 months, and then we got 5 to 10 years. That edged up to 2.9%. Interestingly, how about this last little tidbit here? Consumers also losing confidence that the Federal Reserve is going to deliver them the soft landing, the fabled soft landing. Okay, bringing this back closer to home. Of course, if you're streaming on YouTube, you could be anywhere around the world right now. If you listen to me on the stream, home for me is over here in Australia. So we had the NAB Business Confidence Survey here. Confidence down 5 points, conditions up 3 points. So reflecting that US survey, isn't it? So conditions are getting better, but then we're still really negative about what's to come. Trading conditions were above pre-COVID levels. I think that's really interesting. Employment and profitability out, broad-based gains against all states. So that is showing some significant resilience in the Australian economy. Didn't see a response in the Aussie dollar, did we? Cost pressures are easing. So all tick, 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 all good stuff. But rising interest rates and a gloomy global outlook negatively impacting the confidence side of things, and that's why it suffered. Having a look on the consumer side now, the Westpac Consumer Confidence or Consumer Sentiment Survey, that fell 0.9% to 83.7. This is super interesting, actually. Confidence in jobs, look at that. That is massive, down 11.7%. This is what determines consumer spending patterns. Am I confident in getting a job, having a job? Time to buy a dwelling, down 6.5%. Wealth effects, we're seeing falls in home prices. And I've got cost of living pressures, rising interest rates, slowing economy, all major concerns. We get that. This next bit is awesome. Now, this 83.7 could have been as low as 77.4 if not for the RBA surprise, where they increased rates by only 25 basis points, not the 40 or 50 that the market was expecting. And so they surveyed before and after that surprise. Of course, the net is what we got. But if the Reserve Bank went the full 50 basis points, the consumer sentiment would have literally fallen off the cliff. And how about this house price expectations pre-survey, 85.9, and then boom, RBA slowing their interest rate increases. We're up to 109.3 post-RBA. So yeah, that was a big move from the RBA in terms of managing consumer sentiment, wasn't it? Okay, bringing this back to Australia, we saw gold down 6%, obviously based upon the gold prices. Just looking for the big ones, the information technology suffering. NASDAQ was down 3%. No surprises there. Any surprises? Well, financials up 3%. That's a bit of a surprise. Bench pressing the market. Why was financials so big? I don't know. They're big. They're liquid. They're quote unquote safe. And if you're a big, local pension fund, you've got to put money in the market. That's probably where you do it. And they've got huge index points, so it reduces the whole market when they do. And today's candle is live, so you can see that last one there. We can see the response from Friday's gain, which is in response to Thursday's move in the US markets. And still in trend here. I think that's the message. So short-term trend still down. Short-term trend is actually neutral, to be fair. It's gone orange. Long-term trend is down. If we do create a lower peak here, 68.29 to whatever that one will be, it's not a peak yet, so I haven't marked it, then I think we are heading back down into this demand zone. It has been a significant demand zone, a reliable demand zone between 64.07 and 65.39. So I'd be looking for the candles in there. So assuming this holds today, that would be my bias, certainly to a short-term move to the downside, and then long-term, who knows from there. We'll see if we get a bounce or not. The candles will tell us. So white candles, lower shadows in that zone, and we're probably okay. Black candles, upper shadows in that zone, and we are toast. Talking about toast, the market breadth isn't looking good at all. We should be up here for a healthy bull market. We should be down here for a bear market where the red line is, well, it's not that bad. I guess we're sort of up somewhere in between, but a deterioration from last week. Sector trends, I think, are important. I think the sector trends you want to look at here are the long-term trends, because they are all down except for energy, which is the only sector there in a long-term uptrend. And really, you're going to see, if you want to know when the bear market's ending, these will at least switch to neutral. You're going to have the vast majority of these are neutrals. You're going to have a sprinkling of green in there and ups. But whilst they're all still to the downside, I don't think you can get too excited as an investor. Energy is the only up. Financials managed to get themselves to up, but not too excited about that chart. The rest of them are very much skewed to the downside. Aussie market in terms of valuations here, we talked a lot about technicals, talked a lot about fundamentals, but where are we in terms of how cheap or how expensive Australian stocks are? A lot of numbers on screen, looks overwhelming. It's not that overwhelming. Okay, let me explain. Pre-COVID. So these are long-term averages. This is 3-year averages prior to COVID. So giving us an idea of what normal is for various sectors. Some sectors just tend to be more expensive than others. For example, healthcare. You got CSL, you got Cochlear. They're always trading about 40 times earnings, right? So that's what's normal for them. Okay, where were we last month? 33. Where are we now? 30. So in theory, we're still expensive compared to the long-term average for healthcare, but we're a bit cheaper. Obviously, this is PE, so you want it to be as low as possible. You want to pay as little as possible for the earnings, right? So lower is better or lower is cheaper, right? So healthcare is a bit more expensive than the long-term average. Make of that what you will. But cheaper than it was last month, and certainly getting cheaper from where we were post-COVID when stocks were in the bull market and hitting those highs. Okay, so we have come down from 40 to 30, give or take. That's just healthcare as an example. I'll let you extrapolate the rest, okay, on your own time. You'll find this recording uploaded, there will be a recording of this stream, and you'll be able to watch it and press pause and have a look at those. Suffice it to say, the Australian market at 13.1 is below its long-term average. It's on the right side of cheap, and it's very cheap compared to the peak at 20.1. But what you need to know here is that historically, bull market tops happen around about 22, 23. So not surprising to see this one get to 20 for our bull market top this time around. Historically, 20 and over is expensive. It's where bull markets and crashes, bull markets ending crashes occur. 87 crash, 29 crash, clockwork stuff. Bear markets end when this thing gets to 10 or under. Okay, so you're looking at 8s in the worst case, sometimes 7s. Very, very rare though. 10 and under is your bear market lows. So give you an idea of where we are against some of those historical norms. Okay, looking ahead to this week on the Aussie market, we will be watching for those monetary policy minutes because we saw what a huge impact it had on consumer sentiment, also on the market. Massive rally on Australian shares on the back of that. We'll get to maybe a little bit more information on whether that was justified. That's Tuesday local time, and then we've got the Aussie employment data coming out on Thursday. Looking abroad, actually pretty quiet week. We've got the data dump in China, but I don't think they're going to move markets unless they're really terrible prints. And then in the US, actually welcomingly quiet week with just some housing data there, and the Philly Fed manufacturing index and the Empire State as well. Okay, well, that's it for me today. But if you want some more analysis, tune in tomorrow at 1 p.m. I do it every Tuesday. That's Sydney time. There's the link there, and I'll be doing technicals and fundamentals on your request this time. So bring your portfolio along, ask me questions about your portfolio, and we'll put the stock chart up on screen for that stock, and we'll also have a look at some of the valuations, what the brokers are saying about it as well, broker consensus data. Very interesting. Join me tomorrow. Apart from that, if you are not a client of Think Markets, you really should be, because we are the good guys in the Australian stockbroking scene. We have all the products you need to trade, over 3,100 shares and ETFs, $8 flat rate per trade, which is a great rate when you consider that we give you CHESS sponsored holdings. Well, there are cheaper rates out there in the local market, but you are getting aggregated with everybody else with your holdings, and there are question marks therefore over who the ultimate owner is of those shares. So make sure you've got your CHESS sponsorship. I cannot stress the importance of that, especially if you've got something like a self-managed super fund. If you are looking to trade some of those commodities, we talked about natural gas, maybe potentially having it dip, some of those cryptos which are looking good. Going short on copper, on nickel, and a few of these other things. Actually, I'm not sure if we offer nickel, to be honest, but we definitely offer copper. Indices, whatever you like, overseas shares. And you can trade them with CFDs, with us contracts for difference, market-leading spreads, and commission-free on shares. I mean, just read that a few times over and over again. Commission-free on shares, so you can trade small positions, not have to worry about that. The costs adding up on your commissions there. Award-winning broker. We haven't been around for just 5 minutes. We've been around for many, many years. We are regulated all over the world. We have offices all over the world. We just opened one in Japan. Locally here, we're regulated by the Australian Securities and Investment Commission. or ASIC. Easy to use, multi-asset platform. You can have your self-managed super fund trading on one side, trading shares, CHESS sponsored over here, wonderful. And over on this side, you can be trading short the Australian dollar or long crude oil or short gold or whatever you like, all within that same account platform. World-class trading apps, web, mobile, desktop, whatever you like. Dedicated account manager, 24/7 customer support. And I challenge you to test us on that. We are the best in the business at looking after our clients. Head to thinkmarkets.com/AU for details. If you're watching me on YouTube, either on the stream or on the recording a little bit later on, hit the subscribe button to stay abreast of all of our updates and to get notified when I do go live. And hit the like button there, please, to let me know you like what I'm doing so I continue to do it. Apart from that, it has been a pleasure chatting with you today. All the best for your trading and investing until we catch up again. Bye-bye for now.